This is Matthew Kratter from Trady University, and today I want to answer the question, did stocks just bottom yesterday? Did the stock market bottom? We had this very hot CPI report. Stocks crashed at the beginning, and then we had a very large intraday reversal, which is what I'm going to cover in this video. As we said, CPI inflation came in hot, 0.4% month over month, which is pretty bad if you think about it, especially if you try to annualize those numbers. 8.2% over the last 12 months. That was the headline rate. The core inflation rate, which is basically if you decide not to eat, not to drive your car, and not to heat your house or use any electricity, core inflation came in also hotter than people were expecting. 0.6% month over month, 6.6% over the last 12 months, and that was a 40-year high for CPI core inflation. So even though headline inflation has been slowly coming down, core inflation, in other words, without food and energy, has been rising. And this was something, especially this number, was something that the market was not expecting and did not like to see. I like to personally look at CPI, incumbent core inflation. This is the natural progression of the way our government does statistics. Basically, if you don't like inflation, strip out all components. And if you do incumbent core inflation and you strip out all components of the CPI, inflation is fortunately at zero over the last month and over the last 12 months. I call it incumbent core inflation because this is probably the metric favored by political incumbents of both parties just weeks before the US midterm elections. So there has been this battle on the S&P 500 weekly chart. If we look at the 200-week moving average, that's where a lot of this action has been taking place, and we sold off quite far below that yesterday, then managed to close above it. Some similar reversals happened with the 10-year Treasury yield showing a large shooting star. So yields briefly went above 4% before closing below that level. But the really big reversals were in the stock markets themselves, especially the triple Qs. We have this large candle here where basically we can see if we scroll in, the market gapped down, and that's the bottom of this green column. That's where the market opened. It probed lower lows, and then it finished the day by closing above the previous day's highs. As we'll see, this is called a bullish engulfing candle. Something similar happened with the Dow as well. And we can see the range was huge, all the way from 28,660 up to 30,168 for the high. And it closed much closer to the highs than the low. I often say the market's reaction to the news is usually more important than the news itself. And so this might mark an interesting reversal because we had this worse than expected CPI number, especially the core CPI number, and yet we finished the day much higher than even the previous day. These huge bullish engulfing candles can be an important reversal candlestick. And the thing you want to watch on them is that they're basically in effect until the lows get taken out. So we have some breathing room here, at least for now. The argument against this being a reversal is some of the largest intraday reversals off of a 52-week low have taken place during very deep bear markets and in the midst of them. So if we look at the NASDAQ, for example, this was yesterday. It had this loss at the low and gain at the close. If we look at the next example, that was from March of 2001. This was in the middle of the dot-com bust. The one before that was October 16th, 2008, still fairly early, and November 13th, 2008, still fairly early in the great financial crisis. So these are the two arguments, that it's a reversal or that it's just a bear market suckers rally. If you're finding this video helpful so far, I'd just ask you to hit that subscribe button and hit the like button. So what caused these large intraday reversals? Well, a lot of it is the market trying to anticipate something breaking and a Fed pause followed by a Fed reversal. So we've said on this channel many times, the Fed's going to keep hiking until something breaks, and not just the stock market, but most probably something having to do with the US Treasury market liquidity and functioning. Just a couple days ago on October 11th, we read on Reuters that Janet Yellen, the head of the US Treasury, said that markets are functioning well, and she hasn't seen any problems in particular in the trading of US Treasuries. And then just 2 days later, this article came out that a lot of people are citing that she's now worried about loss of adequate liquidity in Treasuries. So there are large bid-ask spreads. There's a lot of volatility. The market's very thin, and this is a problem for what's supposed to be the world's most deep and liquid market. So this is quite a reversal, and it shows that at least at Treasury, people are beginning to get a little bit worried by market price action. And to the extent they get worried, they can exert pressure on Jerome Powell to not hike rates in November. There was a lot of chatter on Twitter connecting the dots between Governor Bowman, Fed Governor Bowman, talking about rolling back out the SLR and allowing treasuries, allowing U.S. banks to hold more treasuries on their balance sheets by adjusting liquidity ratios. In other words, the sort of capital charges they have to take against things on their balance sheet. And this would be sort of a covert form of quantitative easing, where instead of the Fed taking all of these treasuries on their balance sheet, you'd have the large U.S. banks be given the green light to buy more treasuries and stabilize the market that way. This tweet from Florian Kronewitter saying that he expects this to happen after the midterms and that they're waiting to do this because the problem is you can get a huge spike in oil and this could help Putin. So this is also the thesis we've had on this channel. And I read this article on Bloomberg, and it doesn't seem to be Janet Yellen talking directly about the SLR, the supplementary leverage ratios, but this has been a lot of chatter, and there may be something I'm not seeing. In other words, quantitative easing or QE coming back on the sly in terms of these sort of regulatory changes. Another contrarian take from Peter Berezin was that the CPI report, once people dug into the numbers, was not as bad as the headline number suggested. In other words, all items ex food and shelter were up only 0.1% in September. That's a month-over-month number. And we can see, and it's widely being covered in the news, that rents are finally falling for the first time in the U.S. in a long time, and food inflation is falling as well. So these CPI numbers are lagging numbers, and what the market tries to do is anticipate where they are headed. And so if you take out food and shelter, both of which metrics have been falling, the CPI number doesn't look that bad. So this can also happen as analysts crunch the data in the middle of a trading day, and this could account for the reversal as well. Both the idea that the Fed and the Treasury might be close to calling uncle in terms of the Treasury market breaking, and also that inflation is slowing more quickly enough that they might not need to raise rates very much more. Market, it's important to remember, is a forward-looking future news discounting mechanism. So the CPI number is a lagging number. It's very important. It gives you an idea of trends, etc. But what the market's constantly trying to do is figure out what is going to happen in the next 4 weeks, and 6 weeks, and 8 weeks, etc. And I continue to think that the fact that Bitcoin has still not yet hit new 52-week lows, we saw those lows in June, and they've held at least for the moment. This may be a sign that a Fed pause is coming soon. It might be hopium as well. Only time will tell. If we take a look at how Bitcoin's been performing relative to tech stocks since the beginning of September, we can see Bitcoin down 3.73%, while tech, the triple Qs, is down a little more than 10%. So Bitcoin has been outperforming the stock market over the past 6 weeks or so, which I think is another hopeful sign. I think that Bitcoin is a little bit more of a canary in the coal mine than stocks are in terms of sniffing out where liquidity is coming from and when liquidity is coming back to the market. I thought this was a great tweet from Dylan LeClaire talking about that the last time the U.S. markets, both the U.S. bond market, in other words, treasuries, and the stock market faced a drawdown of this magnitude, the U.S. government defaulted upon its gold peg within the next 24 months. So this really is quite extraordinary. If we look here, we can see that in 2008, the stock market crashed, but bonds did really well. We can see the upper right-hand quadrant here where both stocks and bonds do well, and then the lower left-hand quadrant where both bonds do poorly and stocks do poorly. 1931 was the last year that looked like this, as well as 1969. In 1933 was when FDR moved us further off the gold standard by confiscating all Americans' gold and revaluing the dollar against gold. So it's basically a dollar devaluation against gold. And then it was in 1971 that Nixon severed the link once and for all between the U.S. dollar and gold and physical gold. This does suggest that we are in a monetary reset where the fiat system is failing, and as a result, you're having both bonds and stocks selling off. It's pretty much impossible to time the stock market or Bitcoin bottoms. I called the bottom in the stock market in June or July. That turned out not to be not to be right. I've been right so far about Bitcoin. Again, I think the best way to play this is just to continue to dollar cost average. You buy a little bit of Bitcoin or stocks every single day, every single week, or every single month. You keep the dollar amount the same. So maybe once a week you buy $100 worth of Bitcoin on every Friday. And then if the price of Bitcoin is lower, you end up being able to buy more Bitcoin for that $100. If the price of Bitcoin is higher, the fiat price is higher, you end up buying less. And so this is a nice agnostic way of building up a position in Bitcoin. Again, I've been dollar cost averaging just in Bitcoin. I haven't been buying stocks on these drawdowns. I'm continuing to dollar cost average. I'm keeping my limit orders in case we get a spike, an overnight spike low down to 17,500 or 15,000. I think it's unlikely these get filled, but you never know in these really volatile times. And it's also important to remember that it's great to watch Bitcoin's price pump, but it's even better to be given this longer period as we've been given. And I never thought we'd see this again, but we've been given this longer period to buy cheap sats below $20,000 Bitcoin. So take advantage of this while you can. Do your research, make sure you're prepared to hold, make sure you understand what you're buying. You can check out all the other videos on my channel for this. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.